Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. Our topic today is how does a covered call strategy increase your taxes? Well, let's talk about what a covered call strategy is, and then I think you'll know right off the bat how it increases your taxes. So think about this. A covered call strategy means, for example, you own a stock. You own a stock and you think that stock, you like the stock, maybe you've had it for a long period of time. You don't want to sell it, but you don't think it's necessarily really going to do anything right now. It's not going to go up. You don't anticipate that it's going to do much of anything. So, but somebody else out there in the market might feel that it is going to do something. They say, well, I think that, let's say your stock is at $100 right now, and I really think it's going to move to $120. And the guy says, well, you know, I will pay you for an option to buy your stock at, say, $120. I will pay you $5 for each share. And you're thinking, well, it's, you know, and you have to give me that option for a certain period of time. Maybe 90 days, might be 6 months. Now, when that other person is betting, not only is it going to be going higher than $120 a share, but it really has to go higher than $125 because he's going to pay you $5 and he can't even buy it until he gets to $120. So he would have $125 in it. So he's got to be thinking that the stock will go to 150 or something up. And he could do very well on this because he would make, in essence, $30, he made $25 a share, and then, well, excuse me, 125. If he sold it for 150, he bought it for 125, but he had $5 worth of costs, so he would make a net $20 per share in terms of doing that. And you're saying, well, no, I don't think it's going to go. So what would happen? Well, you get the $5 per share and the stock is still yours. If it doesn't go anywhere, the stock just expires. So you have earned $5, and that $5 is just regular income that you have earned there. So basically, it becomes taxable income to you. That is, unless it's inside of an IRA. A lot of people use this kind of strategy inside of an IRA because it's a good way to create extra earnings. And if you have a stock and you don't think it's going anywhere, or you have no problems with selling it, say when it got to that strike price of $120, then it's a great deal, because at that point, if you'd had it at 100, it went to 20, you'd already gotten 120, you'd already gotten to a situation where you made 5 and it went to 120 or 125, whatever the strike price was. You've made a lot of extra money there. And you might be able to sell make that same $5 deal a couple of times a year, so you pick up $10 extra earnings on that share of stock. And if it never gets exercised, you just made the extra income. So it can be a great strategy. I know a lot of people that have very low income, low tax basis situations like this like to use that strategy. Of course, the problem can come if all of a sudden the stock gets called away and they have to sell it. Then if it's a low basis kind of stock, they can end up having some pretty hefty capital gains. But that's how you could have a situation where you had a covered call strategy that increases your taxable income.